landscape of regulatory reform is now truly global and increasing in scope. While strict global anti-money laundering and know your customer requirements have been with us for a while, laws and regulations aimed at ending global tax evasion are a more recent phenomena. The US tax authorities have for some time been concerned that US taxpayers are evading tax by investing money in foreign institutions, either directly or through foreign entities. In response to those concerns, the Foreign Account Tax Compliance Act, or FATCA, was enacted in 2010 in the US and will be enforced from the 1st of July 2014. FATCA is a complex set of tax regulations, but its objective is simple: to make it more difficult for US persons to avoid tax by investing in foreign institutions, either directly or through foreign entities anywhere around the globe. FATCA is global and extrajudicial in nature and requires both US and non-US financial institutions and other financial intermediaries to become tax collection and information gathering agents on behalf of the US government. FATCA generally requires financial institutions to classify all account holders, both individuals and entities, either as US or non-US. This increases the complexity of customer identification and documentation processes and increases the burden of proof on those financial institutions. Now, to give you an idea of scale, between 50,000 and 100,000 global institutions will be classed as FFIs, including banks, asset managers, insurers, and so on. For example, one of the requirements of FFIs is to inform US tax authorities of offshore accounts with more than 50,000 held by US persons. FATCA also places an onus on FFIs to inform the US tax authorities on the income earned by US persons, information previously only provided by US taxpayers. This has really wide-ranging implications on the way global financial institutions operate and the relationships with clients. Besides the reputational risks and the inability to operate in some markets, the FATCA regulations have a strong compliance lever through the form of a 30% withholding tax. This is payable to the US tax authorities in two cases. Firstly, FATCA-compliant institutions are required to withhold 30% of all US-sourced payments to non-complying financial institutions. Secondly, FFIs may be required to withhold 30% of US-sourced income to customers where adequate documentation doesn't exist. FATCA has a number of obligations for institutions, but there are four key ones. Firstly, FFIs must identify all US accounts, i.e. those accounts that are held directly or indirectly by a US person, including those which are directly or indirectly controlled by more than 10% of a foreign company, like foundations or trusts. This applies to all existing customers as well as new customers. This makes the identification of customers considerably more laborious because the burden of proof has been reversed. Financial intermediaries have to prove that they have no US customers to avoid the 30% withholding tax. Secondly, FFIs must obtain a waiver from account holders to allow information reporting to the IRS. If a client refuses the waiver request, the Act requires the financial institution terminate the relationship. Thirdly, FFIs must provide information to the US tax authorities identifying their US accounts and certain US owners of their customers. In addition, they are required to report relationships with non-participating FFIs and recalcitrant customers. Finally, as previously mentioned, a 30% withholding tax is deducted from payments to FFIs who do not enter into a contract with the US tax authorities and account holders who do not sign a waiver. The US is acting on the assumption that all financial intermediaries will sign the agreement. FATCA is not just another tax issue that impacts compliance activities. It's one of the most ambitious, comprehensive and complex information reporting regimes in the world. It touches the whole value chain of an organisation and requires completely new and extended information reporting systems. Implementing FATCA compliance within an entity requires education and cooperation of not only the tax department, but also of all the other functions within the group, including business lines, legal, operational, IT, risk management and central management.